Hi, I'm Tom Lydon, editor of ETF Trends here in New York at the iShares Connect conference. And I'm here with Matt Tucker, Managing Director in Portfolio Management on the fixed income side over at Blackrock. Matt, thanks for being with us.
Thanks for having me, Tom.
So there's a lot of talk about fixed income, rising rates, fund flows. Where do you see the fixed income market today?
Well, I think we've seen a big shift this year versus 2013. So if you recall, last year was all about short duration. Everybody was afraid rates were going to rise. We saw that big rise in May of June of last year. It spooked a lot of investors. Everyone ran short into short duration funds. This year it's gotten a little bit more nuanced. You know, the Fed has come out and said they're going to be very cautious and slow in how they actually raise rates in the short end. Some investors have gotten more comfortable actually going out the curve, buying duration, buying intermediate, even longer duration funds. So we're seeing, I think, a much different set of kind of outcomes for investors today. And it's become a very interesting environment, I think, for rates and how investors are playing the interest rate market.
So are investors, especially with ETFs, because they're cautious about what Fed might do and when rates might go up, have they become more of a trading mentality, would you say?
Well, I would call it positioning mentality.
Okay.
You know? But I think that's exactly right. If you think about what is an ETF, what does it let you do? It lets you pick your exact exposure. So if I'm an investor and I'm concerned about rising rates, I can buy, say, a short maturity corporate bond fund, right? I still have corporate bond exposure. I still have income coming from corporate bonds, but I have less interest rate risk. And so investors are saying, I want to be either here on the curve, have this much risk, or I actually want to go out the curve, pick up some more yield because maybe I'm not as concerned about the Fed raising rates.
Yeah, absolutely. So let's talk about overseas. There's been a lot of fund flows that we've seen. You've had a lot of fund flows going overseas. Is the average advisor, average investor less concerned about overseas exposure, and is it less perceived risk?
Well, I think that for a lot of investors, you know, QE has actually been, I think, a great thing. So the whole quantitative easing program has pushed rates down in the U.S. It's actually pushed a lot of traditional U.S. investors outside the U.S. bond market, which I actually think is a great outcome long term, right? Yeah. People said if I can only get 1 or 2% in the U.S., where can I go and get some yield? I go overseas, developed markets, emerging markets. That's been the trend. Yeah. More recently, we've actually seen a lot of selling in the emerging market space in fixed income. So if you think about what U.S. investors were buying, they were buying a lot of investment-grade corporates and high-yield corporates here in the U.S. for yield. Right. And the emerging market space was kind of keeping track, but then EM bonds really sold off middle of last year, sold off again in January. And if you look at that market now, it actually looks cheap on a relative basis relative to kind of U.S. dollar corporate. So we're seeing some investors step into that, say, I again want to go outside my home country, step away from my home country bias, buy emerging market bonds to pick up some income. Is still in a market where income is hard to come by.
So as you look on the fixed income landscape, EM debt, pretty good value there.
Well, on a relative value basis, relative to the credit quality, the yield, we're seeing some investors definitely step into that market.
Yeah, how about high yield here in the U.S.?
So high yield here in the U.S. is a bit more of a challenge. You know, if you think about kind of the mentality for a lot of investors, people tend to look at 5% as kind of a magic income level. The yields on high yield are actually getting around that 5% level. It makes some investors cautious. And so some people are actually starting to step away from high yield. I think in today's market, it's an income asset class. You should not expect too much price appreciation, but it could be a place you could still get some income as long as overall conditions of the economy are still pretty favorable.
Great stuff. Matt, thanks for being here.
Thanks, Tom.
Thank you.